This video is audio content only. It does not contain any video footage or images. If you are expecting visual content, please be aware. This is intentionally provided in an audio-only format. We recommend listening to the audio rather than watching the screen. Thank you for your understanding. Welcome to this exploration of mergers and acquisitions in the U.S. insurance industry. Over the next few minutes, we'll examine how consolidation is reshaping this trillion-dollar sector. You'll discover why insurers are merging at record rates, which factors drive these deals, and what this means for consumers and the industry's future. Whether you're an industry professional, investor, or simply curious about the business landscape, this narration will provide valuable insights into one of the most dynamic transformations in American finance. Let's dive in. Chapter 1. Private Equity Reshapes Insurance Distribution. The transformation of the American insurance brokerage landscape over the past 15 years represents one of the most significant structural shifts in the industry's history. At the center of this transformation stands private equity, which has moved from occasional participant to dominant force, fundamentally altering how insurance distribution operates, how agencies are valued, and ultimately who controls the relationship between insurers and their customers. The numbers tell a striking story. Through the first 4 months of 2024 alone, private capital-backed buyers accounted for 142 of the 197 announced insurance brokerage transactions in the United States. That 72% market share represents a dramatic acceleration from just 5 years earlier, when private equity-backed buyers accounted for roughly 59% of all transactions in 2019. This isn't merely growth at the margins. This is a wholesale reordering of market structure, driven by billions in committed capital and a conviction that insurance distribution offers attractive, recession-resistant returns that other sectors cannot match. The appeal for private equity firms rests on characteristics inherent to the brokerage business model. Unlike insurance carriers, which must hold substantial capital reserves against underwriting risk, brokers operate capital-light businesses that generate recurring revenue streams through commissions and fees. A well-run agency with strong client relationships can produce predictable cash flows year after year, insulated from many of the economic headwinds that buffet other industries. When recession threatens, businesses still need workers' compensation coverage. Homeowners still need property insurance. The commission revenue keeps flowing. But the real attraction for private equity lies not in acquiring a single profitable agency, but in executing what the industry calls a roll-up strategy. The playbook has become standardized across dozens of platforms. Acquire a mid-sized regional broker to serve as a foundation, then systematically buy smaller agencies in complementary geographies or specialty lines, integrating them into a centralized operating model that drives cost efficiencies and cross-selling opportunities. Each acquisition adds revenue and EBITDA. Each integration captures synergies. The platform grows larger, more valuable, and positions itself for an eventual exit through sale to a strategic buyer or public offering. Integrity Marketing Group exemplifies the aggressive execution of this strategy. Since 2020, the company completed over 50 acquisitions of independent agencies, building a distribution network focused on life and health insurance products. Acrisure pursued a similar path, completing more than 60 bolt-on deals in the same period, concentrating on niche commercial lines where specialized expertise commands premium commissions. Patriot Growth Insurance Services, Choice Financial, and Risk Strategies Company each built their own versions of the consolidation machine, leveraging centralized service models and technology infrastructure to digest acquisitions at a pace that would overwhelm a traditional insurance broker operating without private equity backing. The mechanics of how these deals get structured reveals much about the changing power dynamics in the market. Valuations for attractive agencies have remained elevated even as broader economic conditions deteriorated through 2023 and into 2024. Small generalist agencies typically trade at 6 to 8 times EBITDA. Mid-sized firms with specialized capabilities or strong niches command 8 to 10 times. Large, high-quality operations with experienced leadership teams, durable client relationships, and demonstrated organic growth can fetch 9 to 11 times EBITDA. By early 2024, these valuations stood nearly 19% above their 10-year average, evidence that demand for quality agencies substantially outstrips supply. What sustains these valuations in an environment where interest rates have risen sharply and credit has tightened? The answer involves both the structural characteristics of brokerage businesses and the specific deal structures that private equity has refined. Unlike traditional M&A transactions that might be financed entirely with debt or equity, broker acquisitions increasingly blend multiple forms of consideration to align incentives and manage risk. A typical transaction might include upfront cash representing 60 to 70% of the purchase price, with the balance consisting of earn-out provisions tied to future performance and seller equity rollover. The earn-out component serves dual purposes. It protects the buyer if the agency's performance deteriorates post-acquisition, shifting some risk back to the seller. But more importantly in the current market, earn-outs allow buyers and sellers to bridge different views on valuation. A seller who believes their agency is poised for accelerating growth can accept a lower upfront payment in exchange for earn-out provisions that could deliver substantial additional value if their optimistic projections prove accurate. Equity rollover arrangements keep sellers invested in the combined entity's success. Rather than cashing out completely, the selling principal reinvests a portion of the proceeds back into the platform, typically retaining anywhere from 10 to 30% ownership in the merged business. This structure has become particularly attractive as the largest private equity-backed platforms have grown to substantial scale. A seller who rolls equity into a platform that later sells to a strategic acquirer at a premium multiple can realize returns that dwarf what they would have achieved through a complete cash-out. The role these platforms play in addressing the industry's succession crisis cannot be overstated. Many independent agency owners built their businesses over decades, accumulating valuable books of business and client relationships, but failing to develop internal successors. Private equity platforms offer these aging owners a solution: achieve liquidity for retirement, potentially retain an equity stake for additional upside, and often continue in a management or advisory role that eases the transition while preserving client relationships and institutional knowledge. Organizations such as Alera Group, High Street Partners, and King Risk Partners accelerated their acquisition counts through 2023 and into 2024. HUB International, Foundation Risk Partners, Alliant Insurance Services, and InZone remained aggressive in pursuing opportunities that expand specialty depth, geographic footprint, or overall scale. Broad Street Partners, InZone Insurance Services, and Integrity Marketing Group together accounted for more than a quarter of all announced transactions in the first months of 2024, demonstrating the concentration of deal activity among the most active platforms. The competitive landscape for acquisitions has grown more complex as environmental, social, and governance considerations enter the equation. Scrutiny from potential acquirers regarding the sustainability credentials of target companies has increased notably. Brokers with strong ESG frameworks, particularly those serving clients in sectors facing climate-related risks, command premium valuations. Acquirers recognize that ESG capabilities will become table stakes for serving corporate clients, making agencies with established ESG expertise and climate risk assessment capabilities more attractive targets. This represents a shift from viewing ESG as a compliance burden to recognizing it as a competitive differentiator that affects acquisition attractiveness. Cyber insurance capabilities have emerged as another critical factor in brokerage valuations and due diligence. Agencies with expertise in cyber coverage placement, cyber risk assessment capabilities, or relationships with cyber markets trade at premiums. But cyber considerations cut both ways. Acquirers increasingly conduct intensive cybersecurity due diligence on targets, recognizing that a data breach at an acquired agency could expose the entire platform to liability and reputational damage. The broker's own cyber hygiene, its data protection practices, security infrastructure, and breach response capabilities can materially affect deal valuations and terms. Some transactions include specific cybersecurity warranties and indemnifications, with earnouts structured to reflect the agency's ability to maintain robust security standards post-acquisition. The convergence between Insurtech and traditional brokerage has accelerated as Insurtech valuations flagged from their pandemic-era peaks. Acquisitions have become increasingly attractive to both private equity investors and traditional carriers seeking to increase technological capabilities without the valuations that would have been required in 2021 or early 2022. Some PE-backed platforms have acquired struggling Insurtechs specifically to integrate their technology platforms and digital capabilities into traditional brokerage operations, creating hybrid models that combine the efficiency of digital distribution with the relationship management and complex risk expertise of traditional brokers. But 2024 brought a development that may signal a fundamental shift in the market's trajectory. A string of blockbuster transactions saw major publicly traded insurance brokers acquire the very private equity-backed platforms that had been consolidating the middle market. In April, Aon completed its acquisition of NFP for approximately $13 billion. Marsh McLennan closed its purchase of McGriff Insurance Services for $7.8 billion. Then, at year's end, Arthur J. Gallagher entered an agreement to acquire Assured Partners for $13.5 billion, a deal explicitly designed to expand Gallagher's reach in the United States middle market for property casualty insurance and employee benefits. These mega deals raise questions about whether private equity's roll-up strategy has reached a natural endpoint. The firms being acquired had themselves acquired hundreds of smaller agencies over the preceding years. NFP had built a substantial footprint across multiple specialty lines and geographies. McGriff operated as a leading middle market broker across the southeastern United States and beyond. Assured Partners ranked among the largest privately held brokers in the country. In each case, the private equity sponsors who backed these platforms realized returns by selling to strategic acquirers willing to pay premium multiples for platforms that had already executed much of the available consolidation opportunity. The regulatory approval process for these mega deals proved more intensive than for typical brokerage acquisitions. Regulators scrutinized market concentration concerns, particularly around whether the combinations would reduce competition in specific regional markets or specialty lines. The Gallagher Assured Partners transaction required commitments around maintaining certain business practices and potentially divesting overlapping operations in markets where the combined entity would hold dominant positions. These regulatory hurdles added months to closing timelines and injected uncertainty into deal execution, considerations that may moderate enthusiasm for future mega transactions even if strategic logic supports them. The strategic logic for the buyers centers on several factors. First, these platforms provide immediate scale in segments where the publicly traded brokers sought to grow. Marsh McLennan's acquisition of McGriff strengthened its position in commercial middle market accounts, an area where regional relationships and local market knowledge provide competitive advantages. Gallagher's purchase of Assured Partners similarly targets the middle market, where thousands of businesses need sophisticated risk management and benefits administration services, but may not require the full capabilities of a global broker. Second, the platforms bring technology capabilities and operational infrastructure that required years and substantial capital investment to build. Rather than developing these capabilities organically, the strategic acquirers can acquire them fully formed, accelerating their own digital transformation and operational efficiency initiatives. Third, and perhaps most importantly from a competitive standpoint, these acquisitions remove potential rivals from the market. Each of the major private equity-backed platforms competed directly with the publicly traded brokers for the same clients and the same acquisition targets. By absorbing these platforms, the strategic buyers consolidate their market position and potentially reduce competitive intensity for future acquisitions of smaller agencies. The implications ripple through the broader market. For the private equity firms that backed NFP, McGriff, Assured Partners, and similar platforms, these exits validate the roll-up strategy and demonstrate that capital deployed into insurance brokerage consolidation can generate attractive returns. That validation will likely encourage additional private equity capital to flow into the sector, funding new platform acquisitions and continuing the consolidation cycle. The pressure to deploy committed capital remains intense. Private equity firms are awash with capital and keen to deploy it, facing pressure from limited partners to put money to work within defined time periods rather than allowing it to sit earning minimal returns while generating management fees. For sellers of agencies across the size spectrum, the landscape grows more complex. Mid-sized agencies face particular pressure as they lack the scale to compete effectively with large platforms while needing substantial infrastructure investments to remain competitive. On one hand, the presence of multiple well-capitalized buyers competing for attractive agencies supports valuations and provides sellers with options. An agency owner in 2024 might entertain offers from several private equity-backed platforms, each offering different combinations of cash, earnouts, and equity rollovers, along with varying philosophies about post-acquisition autonomy and integration. On the other hand, the mega deals that saw strategic acquirers purchase the largest private equity platforms may signal that the most aggressive phase of valuation growth has passed. If the major platforms that drove competition for acquisitions are now owned by publicly traded brokers, and if those brokers pursue more disciplined acquisition strategies than venture capital-backed competitors might, then the competitive dynamics that pushed valuations to 18 or 19% above historical averages could moderate. All of which raises questions about what the insurance distribution landscape will look like a decade from now. If the consolidation trends of the past 15 years continue at their current pace, how many independent agencies will remain? What happens to competition and customer service when a handful of publicly traded brokers and private equity-backed platforms control the majority of commercial insurance distribution? Will carriers concerned about overconcentration among their distribution partners take steps to support remaining independent agencies? Or will the economics of scale and the competitive advantages of size continue to drive consolidation until the fragmented agency system that characterized American insurance distribution for more than a century has been replaced by an oligopoly? The industry now stands at an inflection point. Private equity's transformation of insurance brokerage distribution has already occurred. The platforms are built. The roll-up strategies have been validated. The exits to strategic buyers are being executed. What remains unclear is whether this represents the culmination of a cycle or merely the completion of its first phase. Chapter 2: The Squeeze. The insurance agency, occupying the third floor of a renovated building in Columbus, Ohio, employs 14 people. The founder started the business 32 years ago with a desk, a phone, and relationships built during a decade of working for a national carrier. Over 3 decades, the agency grew steadily, adding producers, expanding into employee benefits alongside its core commercial property and casualty business, and building a book that generates just over $3 million in annual revenue. By most measures, this represents a successful entrepreneurial story. The agency is profitable, serves its clients well, maintains strong carrier relationships, and provides good jobs in its community. Yet the owner, now 61 years old, increasingly feels the ground shifting beneath what once seemed like solid footing. 2 producers left in the past 18 months, both recruited by larger firms that could offer higher compensation, better technology platforms, and clearer advancement opportunities. The agency's incumbent carriers have begun asking for data analytics and risk management capabilities that would require software investments the agency cannot justify at its current scale. Younger clients expect online portals, mobile apps, and digital communication channels that the agency's legacy management system cannot support. And the cybersecurity requirements imposed by state regulators and carrier partners demand infrastructure and expertise that stretch the agency's resources. This agency sits squarely in the segment that industry analysts predict will face the most acute consolidation pressure over the next decade. Firms generating between $500,000 and $10 million in revenue occupy an uncomfortable middle ground. They are large enough that they need substantial operational infrastructure, specialized talent, and sophisticated technology to compete effectively. But they lack the scale to efficiently afford best-in-class capabilities or to spread fixed costs across enough revenue to maintain the profit margins that smaller, leaner agencies or larger, more efficient platforms can achieve. The historical role these mid-sized agencies played in American insurance distribution cannot be understated. For most of the 20th century, they formed the backbone of the industry's middle market. Large national brokers focused on Fortune 500 companies and complex multinational risks. Small local agencies served individuals and very small businesses with straightforward needs. The agencies in between handled the vast middle market of businesses too large for a one-person shop, but too small to require a global broker's capabilities. A regional manufacturer with 200 employees, a hospital system operating 3 facilities, a construction company with annual revenue of $30 million, a real estate development firm managing commercial properties across several states. These clients needed more than simple policy placement. They required thoughtful risk analysis, loss control services, claims advocacy, and employee benefits consulting. The mid-sized agency could provide these services because it had enough revenue to employ specialists in various lines of coverage, to maintain relationships with multiple carrier partners, and to invest in at least basic technology and support infrastructure. That model is fracturing under pressures that intensified dramatically over the past 5 years. Start with the producer economics. An agency generating $3 million in revenue might support 3 or 4 producers, plus several account managers, a couple of customer service representatives, an operations manager, and administrative staff. To maintain healthy margins, the agency needs each producer to generate substantial revenue. But the marketplace for talented commercial lines producers has become ferociously competitive. A producer capable of bringing in $800,000 in annual commission revenue can command a compensation package worth $350,000 to $400,000 or more from a private equity-backed platform or large national broker. That same producer might earn $275,000 at a mid-sized independent agency. The math gets worse when you factor in non-monetary considerations. The large platform offers the producer a team of analysts to help with risk assessment, sophisticated modeling tools to demonstrate value to clients, seamless integration with carrier systems for quoting and binding, access to wholesale markets and specialty carriers that don't appoint smaller agencies, and a clear path to partnership or equity participation in a growing enterprise. The independent agency in the middle segment struggles to match any of these advantages. It cannot pay equivalent compensation without destroying its margins. It cannot afford the same technology tools. It lacks the carrier relationships and market access. And it cannot offer the same growth trajectory because the agency itself may not be growing or may be growing only organically at a pace that seems glacial compared to platform firms like Acrisure or Integrity Marketing adding hundreds of millions in revenue through acquisitions. The technology gap manifests across nearly every aspect of operations. Modern insurance distribution increasingly depends on data integration, analytics, and digital client service. Clients expect to receive certificate of insurance requests fulfilled within hours, not days. They want dashboards showing their loss history, benchmarking against industry peers, and recommendations for risk improvement. They expect their broker to proactively identify coverage gaps and exposure changes rather than simply renewing existing policies. Delivering these capabilities requires integrated systems connecting the agency management platform to carrier systems, to data warehouses, to analytics tools, to client-facing portals. A comprehensive modern technology stack might cost a mid-sized agency $200,000 annually or more when you factor in licensing fees, implementation costs, ongoing maintenance, and the IT expertise required to keep everything running. For an agency generating $3 million in revenue with a 15 to 20% profit margin before owner compensation, dedicating nearly half the profit to technology creates an impossible squeeze. Some agencies in this segment try to compete on the basis of superior personal service and deep client relationships. This can work particularly in communities where the agency has operated for decades and where the principals maintain strong connections with local business leaders. But even this advantage erodes as generational turnover occurs. The business owner who valued the relationship with the insurance agent she has known for 20 years eventually retires or sells to a private equity-backed acquirer who consolidates the company's insurance program with the buyer's existing broker. The next generation of business leaders grew up with Amazon, expects digital service, and may be less swayed by personal relationships than their parents were. Carrier relationships present another dimension of the challenge. Insurance carriers historically relied on independent agencies to distribute their products, compete for business, and serve policyholders. But as the agency landscape consolidated, carriers found themselves in a more concentrated distribution environment. The largest brokers control access to significant portions of certain market segments. They can demand higher commissions, favorable terms, and additional support from carriers who depend on them for volume. Mid-sized agencies lack this leverage. Worse, carriers increasingly expect all their distribution partners, regardless of size, to meet higher standards for technology integration, data quality, and operational efficiency. A carrier might require agencies to submit all commercial applications through a specific portal, to provide loss runs in a standardized format, to maintain certain service level agreements for policy servicing, and to meet compliance requirements around cybersecurity and data privacy. Each of these requirements imposes costs. Building the interface to the carrier portal requires IT resources. Standardizing data formats demands staff time and possibly new software. Meeting service level agreements may necessitate additional headcount. Compliance requirements force investment in security infrastructure, staff training, and documentation. A national broker or private equity platform spreads these costs across billions in revenue. An agency doing $3 million in revenue bears the same fixed cost with a fraction of the revenue base to absorb it. The regulatory burden compounds the problem. State insurance departments have substantially increased their requirements around cybersecurity, data breach notification, market conduct, and consumer protection over the past decade. These regulations don't scale to agency size. A small agency faces essentially the same compliance obligations as a large one. The difference is that the large agency employs dedicated compliance staff, invests in comprehensive compliance management systems, and can afford specialized legal counsel. The mid-sized agency tries to have its operations manager handle compliance in addition to their other responsibilities, relies on less sophisticated tools, and hopes nothing goes seriously wrong. When something does go wrong, a data breach, a regulatory examination, an errors and omissions claim, the mid-sized agency often lacks the resources to respond effectively. This reality increasingly drives agency owners to consider whether the risk of continuing as an independent operator outweighs the benefits of joining a larger organization with robust risk management infrastructure and deep pockets to handle problems when they arise. The mathematics of the situation becomes stark when you project forward. Consider an agency currently generating $4 million in revenue with a 20% EBITDA margin of $800,000. The owner, age 58, contemplates the next 10 years. To remain competitive, the agency probably needs to invest an additional $300,000 over the next 3 years in technology upgrades, cybersecurity infrastructure, and regulatory compliance capabilities. It needs to increase producer compensation to retain its existing team and to have any hope of recruiting new talent, which will compress margins. Carrier commission rates may come under pressure. Organic growth of 4 to 5% annually might be optimistic given competitive pressures. Even in a favorable scenario, the agency might reach $5 million in revenue with EBITDA margins that have shrunk to 15% by the time the owner reaches retirement age. Against this scenario, the owner weighs selling now to a platform. From a pure financial standpoint, accepting an offer delivers more certain value than the uncertain future returns from continuing to operate independently. But the decision involves more than money. The owner built this business. Many of the clients are personal friends. The employees depend on their jobs. The agency is woven into the fabric of the local business community. Selling means ceding control, integrating into someone else's systems and culture, answering to new bosses, and accepting that the independent agency bearing his name will eventually be absorbed into a larger brand. These tensions play out thousands of times across the country as owners of agencies in this segment confront their options. Some choose to fight for independence, doubling down on technology investments, focusing on niche specializations where they can compete effectively, and hoping to grow their way to a more sustainable scale. This path can work, particularly for agencies with genuine specialized expertise in areas like construction insurance, healthcare professional liability, or cyber coverage for technology companies. But it requires capital, risk tolerance, and often a younger leadership team with years ahead to realize the returns on heavy near-term investments. Others attempt merger with a peer, combining two mid-sized agencies to create a larger entity with better scale economics. The traditional internal perpetuation model, where junior partners would buy out retiring principals over time using the agency's cash flow, has become increasingly difficult to execute, as rising valuations mean internal buyers need access to more capital than most can accumulate. Skill gaps compound the challenge. An account manager who excels at client service may lack the sales capabilities or business acumen to run the agency. Extended payment terms that spread the purchase price over 10 or 15 years create risk for both parties if market conditions change or if the business underperforms. In theory, a merger of equals can preserve some of the independence and local character that owners value while achieving cost synergies and improved competitiveness. In practice, mergers of equals often prove challenging to execute. Cultural integration is difficult. Leadership roles must be negotiated. Redundant positions must be eliminated. And the combined entity may still not reach the scale necessary to compete effectively with the largest platforms, simply creating a larger agency that still faces many of the same structural challenges. The third path, which data suggests growing numbers are choosing, is to sell to a well-capitalized buyer and accept that the era of the independent mid-sized agency is drawing to a close. Through the first months of 2024, acquisition activity in this segment accelerated sharply, driven by private equity platforms executing their roll-up strategies and by some mid-sized agencies proactively seeking partnerships before their competitive position deteriorates further. What happens when these agencies sell reveals much about the changing nature of insurance distribution. Initially, clients often notice little change. The agency retains its name, at least for a time. The same people answer the phone and handle their accounts. Service continues. But gradually, the integration proceeds. Policies migrate to the acquiring platform's management system. Accounts get reassigned to centralized service teams. Producer compensation structures change. The local decision-making authority that characterized the independent agency gives way to processes and approval hierarchies that flow from a regional or national office. For some clients, particularly larger or more sophisticated accounts, this transition may actually improve service. The platform can bring resources, expertise, and carrier access that the independent agency couldn't match. A manufacturing client that previously outgrew their local agency's capabilities may benefit from the risk management services, loss control support, and sophisticated analytics the platform provides. An employer struggling with health insurance costs may get better outcomes from the platform's benefits consulting resources than the independent agency could deliver. But other clients, particularly smaller businesses that valued the personal relationships and local knowledge, may find the experience less satisfying. The agent who knew their business intimately gets promoted or leaves. Service requests get routed through a call center. Coverage decisions that the local principal would have made based on relationship and judgment now follow standardized underwriting criteria applied consistently across the platform. The insurance broker transitions from a trusted advisor who was also a neighbor and community member to a vendor relationship managed through digital portals and service-level agreements. Employees face similarly mixed outcomes. Producers with strong books and solid skills often thrive after an acquisition. The platform provides them better tools, higher compensation, and more opportunities than the independent agency could. Support staff may find improved benefits, more training, and clearer career paths in the larger organization. But some employees discover that their roles are redundant or that the culture of the platform doesn't fit their working style. An account manager who enjoyed the variety and autonomy of working in a small agency may find the specialized, process-driven environment of a large platform less fulfilling. Communities lose something less tangible but nonetheless real. Independent insurance agencies historically played roles beyond their commercial function. Principals served on nonprofit boards, sponsored youth sports teams, participated in chambers of commerce, and contributed to civic life in ways that reflected their roots in the community. When the agency sells to a distant platform, those connections often weaken. The local principal may remain involved during a transition period, but eventually retires or moves to other opportunities. The platform's leadership has no particular tie to the community beyond the revenue the local office generates. The agency office becomes a branch location, one of hundreds, distinguished primarily by its production numbers rather than its community relationships. Yet, to characterize this transition purely as loss misses important context. The consolidation of the middle segment is not occurring because of predatory private equity or anti-competitive practices. It is occurring because the economics and competitive requirements of modern insurance distribution increasingly favor scale. The agencies being acquired are not being destroyed. Their clients continue to receive service. Their employees largely keep their jobs, often with better compensation and benefits. The owners achieve liquidity and often financial outcomes superior to what they could have realized through internal perpetuation or a slower decline in competitive position. The question that remains is whether the industry structure will stabilize at some new equilibrium or whether consolidation will continue until the middle segment effectively disappears. Projections from industry analysts paint a stark picture of the distribution landscape by 2035. The number of very small agencies with revenue under $500,000 will grow from approximately 19,950 to 23,750 as new entrepreneurs enter the business, often focusing on narrow niches or serving specific demographic communities. The number of large agencies with revenue exceeding $10 million will roughly double, from 510 to over 1,000. But the middle segment, the agencies currently generating between $500,000 and $10 million in revenue, will shrink substantially as consolidation pressure proves overwhelming. If this projection proves accurate, it raises questions about market structure and competition that extend beyond the insurance industry. What happens when an oligopoly of large brokers controls the bulk of middle-market insurance distribution? Do clients benefit from the efficiency and capabilities these large platforms provide, or do they lose the advocacy and customized service that smaller independent brokers offered? Will the remaining independent agencies operating at very small scale be able to survive in the niches they occupy, or will the platforms eventually absorb them as well? For the owner of that agency in Columbus, contemplating these industry-wide questions provides little guidance for the immediate decision. The acquisition offer sits on the desk. The deadline for responding approaches. And whether his choice to hold or sell matters more to him personally or to the broader structure of American insurance distribution remains an open question with no certain answer. Chapter 3. Insurtech Valuations and Artificial Intelligence Adoption Disrupting Traditional M&A. The conference room at the headquarters of a century-old property and casualty insurer in Hartford buzzed with tension in early 2022. On one side of the table sat executives who had guided the company through decades of steady growth. On the other sat representatives of an Insurtech startup barely 4 years old, presenting a valuation exceeding $1 billion despite never having turned a profit. The startup's pitch centered on algorithmic underwriting, real-time policy adjustments, and a mobile-first customer experience. The discussion eventually collapsed not over price, which the traditional insurer might have been willing to pay, but over culture and control. Within 18 months, that same Insurtech would lay off 330 employees, shutter operations in multiple states, and watch its valuation crater to a fraction of what it had commanded. The carrier executives would revisit acquisition discussions, this time on dramatically different terms, and would ultimately acquire key technology assets for less than 10% of the original asking price. This trajectory, from stratospheric valuations to fire-sale acquisitions, has defined the Insurtech sector's evolution and created a new category of merger and acquisition activity that blurs the lines between technology purchases and traditional insurance industry consolidation. The Insurtech boom that accelerated through the late 2010s and peaked in 2021 rested on a conviction that technology would disrupt insurance the way it had disrupted retail, transportation, and hospitality. Venture capital poured into startups, promising to eliminate friction from the insurance purchasing process, to use artificial intelligence for more accurate risk assessment, to leverage connected devices for personalized pricing, and to provide digital native experiences for customers frustrated with legacy carriers' cumbersome processes. Investment into the Insurtech sector reached $15.5 billion across 566 deals in 2021, with much of this growth concentrated in the United States market. But insurance proved resistant to the disruption playbook that worked in other industries. The challenges emerged across multiple dimensions. Start with the regulatory environment. A technology company disrupting retail or transportation operates in a relatively light regulatory framework. An insurance company must obtain licenses in every state where it operates, maintain capital reserves that vary by jurisdiction and product line, file rates and forms with state regulators, and comply with market conduct requirements that constrain how it acquires customers and handles claims. The capital requirements proved particularly challenging for Insurtechs attempting to operate as carriers rather than as technology providers to existing carriers. Writing insurance requires holding substantial capital against potential losses. A traditional carrier builds this capital base over decades of profitable operations. An Insurtech starting from scratch must raise enormous amounts of capital before it can write meaningful premium volume. And regulatory requirements mean it sits on the balance sheet supporting underwriting capacity rather than funding technology development or customer acquisition. The unit economics often fell apart when confronted with insurance market realities. Consider usage-based auto insurance, where Insurtechs believed they could use telematics data to more accurately price risk and attract safer drivers. In practice, customers most eager to adopt usage-based insurance tended to be those who believed they were better than average drivers. But self-assessment of driving skill correlates poorly with actual accident risk. Meanwhile, the cost of providing and maintaining telematics devices or apps, processing and analyzing the data, and handling customer service for a more complex product eroded the margin advantages the technology was supposed to create. The competitive response from traditional carriers compounded Insurtech struggles. Once it became clear that customers valued certain digital capabilities like mobile apps, instant quotes, and streamlined claims processes, the large carriers invested in developing those same capabilities. They had advantages the Insurtechs lacked: established brand recognition, massive customer bases to amortize technology costs across, and profitability from existing books of business that could fund the transition. By late 2022, the Insurtech valuation correction was well underway. Companies that had gone public at valuations reflecting expectations of hypergrowth watched their stock prices decline as growth slowed and paths to profitability remained unclear. Private companies seeking to raise additional capital faced down rounds where new investors valued them at fractions of their previous valuations. Yet this correction created opportunities that traditional carriers had been waiting for. While the Insurtech business models often failed to deliver on their promise of disrupting the insurance industry, the underlying technology they developed frequently had genuine value. An Insurtech might have failed because it tried to operate as a carrier without the capital or expertise to manage insurance risk effectively. But the underwriting algorithms it developed, the user interface it designed, the data integration capabilities it built, these assets could be tremendously valuable to a traditional carrier that had the risk management expertise and capital base the Insurtech lacked. USAA's acquisition of Insurtech Nobler in June 2021 illustrated one approach to capturing this value. USAA had already developed its own telematics product, SafePilot, which it launched in 2018 and expanded to 34 states by 2021. But acquiring Nobler allowed USAA to accelerate its ability to personalize pricing to fit drivers' risk and use profiles. Rather than attempting to build every capability organically, USAA could integrate Nobler's innovations into its existing operations, combining the startup's technology focus with the carrier's scale and insurance expertise. Lemonade's acquisition of Metromile demonstrated a different dynamic. Lemonade itself was an Insurtech that had successfully gone public but faced questions about its path to profitability. Acquiring Metromile, a struggling pay-per-mile auto insurer, allowed Lemonade to gain access to the customer driving data that Metromile had accumulated since its founding in 2011. Additionally, Metromile's licenses in 49 states provided Lemonade a platform for rapidly scaling its auto insurance business without the lengthy process of obtaining those licenses independently. The acquisition highlighted how assets that might seem peripheral to insurance, databases of driving behavior, state licenses, technology infrastructure, could become the primary value in an Insurtech transaction. Metromile had failed as a standalone business, but the data it collected, the regulatory approvals it obtained, and the technology it built all had value to an acquirer with a different business model and more capital to deploy. European carriers approached Insurtech acquisitions with somewhat different calculus. German insurer HDI acquired Insurtech Community Life, founded in 2014, to accelerate its digital capabilities for direct-to-consumer sales and add innovative capabilities such as biometric insurance. Nürnberger Versicherung became lead investor in the insolvent Insurtech Getsurance, gaining access to innovative products and enhanced digital sales capabilities at a distressed valuation. The partnership between digital startup Singlife and incumbent Aviva Singapore operations took yet another form. Rather than a pure acquisition, the merger combined Singlife's digital capabilities and mobile-first customer engagement with Aviva Singapore's product history and advisory services. The structure allowed both parties to contribute what they did well while creating a combined entity positioned to compete more effectively than either could alone. American Family's purchase of digital exchange Bold Penguin illustrated still another dimension of Insurtech M&A. Rather than acquiring a carrier or a provider of direct-to-consumer insurance products, American Family bought a marketplace platform. The strategic logic recognized that the carrier's proprietary products would not always be the best solutions for customers. By owning Bold Penguin's marketplace, American Family could offer a range of choices that enhance the customer value proposition while expanding distribution capabilities. Then artificial intelligence emerged as a new transformative force, changing the calculus yet again. Insurance had always been a data-intensive business, but the analytical approaches most carriers employed had evolved slowly. AI offered fundamentally different approaches to core insurance functions. Rather than relying on predefined models and human judgment, AI systems could identify patterns in vast datasets that no human analyst could detect. They could price risk more accurately by incorporating hundreds of variables and complex interactions between them. They could automate underwriting decisions that previously required experienced judgment. They could assess claims with greater speed and consistency than human adjusters. The potential efficiency gains were substantial. A carrier that could automate 80% of its underwriting decisions while maintaining or improving accuracy could reduce costs dramatically and speed up quote delivery. A claims operation that could use AI to assess property damage from photos submitted via a mobile app could settle straightforward claims in hours rather than days, while freeing adjusters to focus on complex cases requiring human expertise. But developing these AI capabilities required expertise that most traditional carriers lacked. The skill sets needed to build and deploy effective AI systems differed fundamentally from traditional insurance expertise. Carriers needed data scientists, machine learning engineers, software developers skilled in modern cloud architectures, and specialists in emerging areas like computer vision and natural language processing. More fundamentally, building AI systems required a different approach to technology than most carriers had historically employed. Effective AI implementation required more agile, experimental approaches. It meant working with cloud infrastructure, building modular systems that could be rapidly updated, running experiments to test different models and approaches, and accepting that not every initiative would succeed. Insurtech companies, particularly those that had survived the valuation correction, were often better positioned to deploy AI capabilities. They had built their technology stacks with modern architectures from the ground up. They had hired teams with the right skill sets. They had organizational cultures that embraced experimentation and rapid iteration. But many still lacked the capital, the risk management expertise, and the market presence to succeed as standalone carriers. This created a new dynamic in insurance M&A. Traditional carriers looking to acquire AI capabilities could attempt to build them organically. But this approach faced challenges of integrating new capabilities into legacy systems, changing entrenched organizational cultures, and competing for talent. Alternatively, carriers could acquire insurtechs that had already built the AI capabilities and modern technology platforms. These acquisitions came with different risks than traditional M&A. The value resided primarily in people and intellectual property rather than in books of business and customer relationships. The regional dynamics took distinct forms. In Asia, particularly in countries with high internet penetration like Indonesia, Vietnam, the Philippines, and Thailand, private equity investment into Insurtech remained active across various stages of development. Prospective capital providers split fairly evenly between international firms and regional asset managers, each seeing opportunities to build platforms that could serve emerging middle-class populations through digital channels. The acquisition activity focused more on building new distribution capabilities than on acquiring core insurance technology. Europe saw more limited insurtech investment, with partnerships between insurtechs and traditional carriers emerging as a more common structure than outright acquisitions. The regulatory environment, fragmented across multiple jurisdictions, each with its own requirements, made it difficult for insurtechs to achieve pan-European scale. Traditional carriers with existing cross-border operations could partner with insurtechs to pilot new technologies in specific markets, scaling successful approaches while limiting risk. The cyber insurance segment illustrated both the opportunities and risks in the intersection of AI, insurtech, and M&A. Cyber coverage had seen explosive growth as businesses recognized their exposure to data breaches, ransomware, and business interruption from cyber incidents. The complexity of assessing cyber risk made it a natural application for AI capabilities. Insurtechs focused on cyber coverage developed sophisticated models incorporating real-time threat intelligence, automated security assessments, and continuous monitoring of insured networks. The complexity of assessing cyber risk made it a natural application for AI capabilities. Insurtechs focused on cyber coverage developed sophisticated models incorporating real-time threat intelligence, automated security assessments, and continuous monitoring of insured networks. Looking ahead, the insurance M&A market appeared poised for continued activity driven by AI adoption, but the nature of that activity would likely differ from the Insurtech boom and bust of the previous cycle. Rather than venture-funded startups seeking to disrupt traditional carriers, the more likely pattern involved carriers acquiring targeted capabilities to enhance their existing operations. Rather than paying for revenue growth and customer acquisition, acquirers would pay for technology, talent, and intellectual property that could be deployed across their existing books of business. The strategic question facing every carrier's board became not whether to invest in AI and advanced technology, but whether to build, buy, or partner. The executives who had sat in that Hartford conference room in 2022, watching an Insurtech pitch a billion-dollar valuation, would recognize that they had been right to hesitate at the price, but perhaps wrong about the underlying value. The technology was real. The capabilities mattered. The competitive pressures were not going away. But the path to capturing that value ran through carefully structured acquisitions at rational prices, not through lottery ticket bets on revolutionary disruption. Chapter 4. The Cost of Money. The chief financial officer of a regional life and annuity carrier sat in her Indianapolis office in March 2023 reviewing quarterly results that told two contradictory stories. On one side of the ledger, policy sales had slumped as customers balked at premium increases and competitors offered more attractive rates. Surrender activity accelerated as policyholders cashed out older contracts to pursue better returns elsewhere. The actuarial team projected that if these trends continued, the company would see net premium outflows for the first time in its 70-year history. But on the other side of the ledger, something remarkable was happening. The company's investment portfolio, which for more than a decade had scraped along at yields barely exceeding 2%, was suddenly generating returns approaching 5% on new investments. Bonds maturing from the low-rate era could be replaced with treasuries and investment-grade corporates paying multiples of what they had yielded just 18 months earlier. The CFO's spreadsheet showed that if the company could stabilize its in-force book and deploy even a fraction of its assets at these higher rates, the improvement in investment income would more than offset the underwriting headwinds. This tension between underwriting challenges and investment opportunities created by rising interest rates permeated every discussion about insurance sector merger and acquisition activity through 2023 and into 2024. The yield on 10-year Treasury notes, which had languished below 2% through much of the 2010s, climbed above 4%. Corporate bond yields followed, and suddenly insurance companies found themselves operating in a fundamentally different financial environment than the one that had prevailed for most executives' entire careers. For life and annuity carriers, this created a strategic inflection point that would reshape the sector's merger and acquisition landscape. Many carriers had built strategies around products designed for a low-rate world. Fixed annuities offered guaranteed minimum returns, but those guarantees had been set when even conservative investment portfolios could generate 3 to 4% returns. As rates fell, carriers found themselves in a squeeze, owing policyholders guaranteed minimums while their investment portfolios increasingly consisted of bonds yielding less than those guarantees. The arithmetic became unsustainable unless the carrier could grow its way out of the problem, writing new business at more favorable economics to dilute the legacy blocks, dragging down overall returns. The improving investment environment meant that new business could be written at substantially better economics. An annuity sold in 2023 could assume investment returns of 4 or 5% rather than 2 or 3%, allowing the carrier to offer competitive credited rates to customers while maintaining healthy spreads for shareholders. For carriers with the capital and risk appetite to pursue growth, this created genuine opportunity. More importantly, the rate environment created opportunities to offload legacy blocks that had become economic burdens. Specialized companies focused on legacy reserve management, backed by private equity and alternative asset managers, had built business models specifically designed to acquire these troubled blocks. Hartford Financial Products International's sale to Catalina illustrated this dynamic. Hartford had been managing certain legacy liability exposures that no longer fit its strategic focus. Catalina, a specialist in acquiring and managing runoff insurance portfolios, saw value in assuming those liabilities because its business model and cost structure allowed it to manage the runoff more efficiently than Hartford could, while operating them as a non-core segment of a larger organization. Enstar's acquisition in a $5.1 billion take-private transaction by 6th Street signaled that private equity saw continuing opportunity in this legacy reserve space. Enstar had built a business over decades acquiring legacy reserves from carriers looking to exit unprofitable or non-strategic blocks. The 6th Street acquisition reflected a conviction that even with rising interest rates improving the outlook for new insurance business, plenty of carriers would still prefer to shed legacy exposures rather than manage them through a transition that could take years or decades. The pension risk transfer market represented another dimension where interest rate changes drove M&A activity through specific economic mechanisms. For years, corporations with defined benefit pension plans sought ways to reduce the volatility these plans created on their balance sheets. When interest rates were low, the present value of pension liabilities ballooned, creating massive funding deficits. As rates rose, higher discount rates reduced the present value of pension liabilities, improving funded status for many plans. This created a window where corporations with well-funded or overfunded pension plans could transfer the liabilities to insurance companies through pension buyouts. The economics of these transactions shifted materially with rate changes. A corporation transferring $1 billion in pension liabilities to an insurer in 2023 paid a premium reflecting the present value of those obligations discounted at current rates. The insurer, in turn, invested that premium in bonds yielding 4 to 5%, creating a spread over the benefits owed that could reach 100 to 150 basis points on well-structured transactions. Compare this to 2019, when the same transaction might have generated spreads of only 50 to 75 basis points because the insurer's investment options yielded so much less. The improved spread made pension risk transfers materially more attractive to insurers, driving increased competition for this business and making carriers with substantial PRT books more valuable acquisition targets. For property and casualty carriers, interest rate impacts flowed through different channels. The investment income P&C carriers generated on their float, the premiums they collected and held before paying claims, represented a substantial portion of overall profitability. Through the low-rate era, this income stream shrank to levels that sometimes failed to offset underwriting losses. The same premium dollar that might have earned 1.5% annual investment return in 2020 could generate 4% or more by 2023. For a large carrier holding billions in invested assets, this improvement flowed straight to the bottom line. Because P&C liabilities were shorter duration, carriers could reinvest maturing bonds relatively quickly, turning over their portfolios to capture higher yields faster than life insurers locked into longer duration liabilities could. A commercial lines carrier with an average liability duration of 3 years might see half its investment portfolio repriced to higher yields within 18 months of rates rising. A life carrier with annuity liabilities extending 20 or 30 years might take a decade or more to fully turn over its portfolio. Yet the property catastrophe market complicated this otherwise favorable picture. Climate-related events had been increasing in frequency and severity, creating underwriting losses that exceeded even improved investment income. These catastrophe-related pressures created both opportunities and risks for M&A activity, with improving investment income providing a larger cushion but unable to offset truly catastrophic underwriting losses if acquired business proved mispriced. The impact on M&A deal financing revealed patterns that contradicted simple theory. Economic theory suggested that when interest rates rise, the cost of debt increases, making leveraged acquisitions more expensive and reducing the prices buyers are willing to pay. Yet insurance M&A activity remained robust despite tightening credit conditions. The explanation for this apparent contradiction revealed the structural dynamics at work. The recurring revenue model of insurance agencies generated cash flows that lenders viewed as high quality. Unlike a manufacturing business where revenue depended on winning new contracts in competitive bids, a well-run insurance agency could forecast its renewal revenue with considerable confidence. This predictability meant lenders remained willing to provide debt financing for brokerage acquisitions, even as they pulled back from other sectors. The financing mechanics changed in specific ways. When a private equity platform acquired a mid-sized agency in 2019, it might have financed the deal with 60% debt at an interest rate of 4%, creating an annual debt service cost of 2.4% of the purchase price. By 2023, the same platform might only be able to secure 50% debt financing, and at an interest rate of 7%, creating an annual debt service cost of 3.5% of the purchase price. This 46% increase in financing cost should theoretically reduce the price the platform could pay. But the competition among buyers sustained activity. If one buyer's cost of capital constraints forced them to step back from a specific multiple, another buyer with different financing sources or return requirements would step in. For sellers, tax considerations added urgency to transact despite tightening financing conditions. The prospect of capital gains tax increases and the expiration of the Tax Cuts and Jobs Act scheduled for 2025 meant that sellers who wanted to capture current tax treatment might have a limited window. This temporal pressure helped sustain deal volume even as financing became more expensive. Large transformational acquisitions became harder to finance in the higher rate environment. When buyers needed to arrange substantial debt facilities for billion-dollar deals, convincing lenders of the combination's strategic logic and demonstrating that the integrated business could service the debt load became more challenging. Smaller bolt-on acquisitions faced fewer obstacles because financing requirements were more manageable and could often be funded from the platform's operating cash flow without requiring large amounts of new debt. The life and annuity sector M&A market operated under different dynamics. The valuation depended on assumptions about future investment returns, mortality experience, policyholder behavior, and regulatory capital requirements. Higher rates improved the outlook for investment returns, which should increase the value of a life insurance block. But higher rates also created risks around policyholder surrenders if customers could earn better returns elsewhere. Higher rates reduced the present value of future liabilities, improving the capital position. But they also affected the market value of existing investment portfolios in ways that could create accounting losses even if the economics remained sound. A traditional life carrier evaluating a legacy annuity block in 2023 might project that at current interest rates, the block could generate returns on equity of 9% over the next decade. At the rates that prevailed in 2019, the same projection might have shown returns of only 6%. This 3 percentage point improvement in projected returns could justify a valuation premium of 20 to 30%, even though the underlying liabilities and cash flow patterns remained identical. The difference resided entirely in the rate environment and its impact on investment income. For sellers, this created opportunities to find buyers with different perspectives. A buyer with access to private credit markets yielding 6 to 7% might value a block differently than a buyer limited to investment-grade bonds yielding 4 to 5%. A buyer with long-duration liabilities to match against the assets might value the block differently than a buyer focused on shorter payback periods. The transaction could create value for both parties even though they were trading the same assets and liabilities, simply because each party valued them differently given their specific circumstances and investment opportunities. As 2024 progressed and attention turned toward 2025, the insurance M&A market confronted questions about how the rate environment would evolve. Federal Reserve officials began discussing the possibility of rate cuts, though the precise timing remained uncertain. If rates moderated significantly, the dynamics that had sustained certain types of insurance M&A activity could shift materially. For life insurers, a decline back toward the lows that prevailed through most of the 2010s would intensify pressures that had made legacy block sales attractive. Carriers struggling to generate adequate returns on capital would face renewed urgency to divest non-core businesses. The same companies that had avoided selling in the improving environment of 2023 and 2024 might find themselves back in the market as sellers if the rate outlook deteriorated. But if rates stabilized at levels materially higher than the lows of the 2010s but below the peaks of 2023, life insurers could find themselves in a relatively favorable position where investment portfolios would gradually turn over to higher-yielding assets without creating the surrender risk that sharply rising rates could trigger. The property and casualty carriers, benefiting from better investment income but facing climate-related catastrophe losses, faced their own calculus. The improved investment returns provided cushion against underwriting volatility, making carriers with strong catastrophe risk management capabilities more valuable. But the improvement also reduced the urgency to pursue M&A as the primary path to better returns. A carrier that could achieve its return on equity targets through organic growth and improved investment income had less reason to take on the integration risk and capital deployment that acquisitions required.
What remained unclear was whether the relationship between interest rates and insurance M&A activity would prove as straightforward as economic theory suggested, or whether the structural factors driving consolidation would continue to dominate regardless of where rates settled. The answer would determine not just transaction volumes and valuations, but the fundamental shape of the insurance industry's competitive landscape for decades to come.
The American insurance industry stands at a historic inflection point. Private equity has fundamentally restructured distribution, with platforms controlling over 70% of brokerage transactions. Mid-sized agencies face existential pressure from technology requirements, talent competition, and regulatory burdens. Insurtech's boom and bust cycle has given way to strategic acquisitions focused on artificial intelligence capabilities rather than business model disruption.
And rising interest rates have transformed the economics of life insurance, annuities, and property casualty operations in ways that will reverberate for decades. These forces converge to raise profound questions about competition, consumer choice, and community relationships. Will consolidation stabilize at a new equilibrium or continue until a handful of platforms dominate? Can scale and efficiency coexist with personalized service and local accountability? The answers will determine not just which companies survive, but what kind of insurance industry America will have in 2035. Thank you for listening.